In this episode, we're breaking down everything you need to know about getting qualified for a mortgage, what lenders look at, how to prep your finances, and how to avoid the biggest mistakes that could cost you your dream home. Let's get into it. Hi, my name is KQuame. I've been in the mortgage and banking industry for nearly 18 years with an extensive background from start to finish, operations to origination. All right, let's start with this. Why is the pre-qualification the first step to buying a home? It's really the only way you're going to know 100%. You need to know before you start looking to make sure you have your price point picked out, make sure you can afford the payment, and just to see where you're at in general. Oftentimes, many people think that their credit score is great. They look on their apps. It says this, but sometimes that's not always 100% correct. It's also never too early to start. I've had several people say, well, I want to pay something off first. I want to get my credit improved, but I can help with all of that, and it's at no cost to you. Pre-qualifications are good for usually up to 120 days for the credit report. So like I said, it's never too early to start. Get you on a plan if needed, or maybe you're ready to go right out of the gate. All right, what's the difference between pre-qualification and pre-approval, and which one actually matters? Well, technically they both do. You will hear both terms back and forth. It essentially means the same, but the main difference when somebody says or is pre-approved, that means their file has actually been looked at by an underwriter. It's a little more in-depth review versus just the loan officer looking at the pay stubs, bank statements, and then issuing that pre-qualification letter. A pre-approval is basically the next step. But I always like to say, since I was an underwriter for 7 years, my pre-qualification is probably a pre-approval. So if I called you today to get pre-qualified, here's what we would do. We would start with an application. We would tackle the three biggest items, which are credit, income, and assets. We'd go over your credit, see where you're at for credit scores. Lenders always use the middle of the three scores for qualifying. We'd see if there's any ways to possibly improve the credit if needed, and maybe not. Maybe you're good to go. The income is we look at what type of income you have. Are you W-2'd? Are you salaried? Are you self-employed? Verifying all that will allow us how we qualify you because being salaried or W-2 is different than being self-employed. The final piece is your bank statements or assets. Seeing what you're comfortable or what money that you have for down payment, closing costs. We can see like maybe putting more down is beneficial to you. Maybe it's not. Maybe putting less down. Basically kind of going over all your options, payment structure, and your down payment. Then, once we have completed the application and you know what you can qualify for, then you can go out and have some fun. I know my part is usually the boring and not very interesting, but it is the most important. Now you're free to go out and look with your realtor, look at all the homes, and do all the fun stuff. Let's talk about debt to income and why it matters. The debt to income ratio is a ratio that lenders use for qualifying, and it gives you a pretty good varying range. It's important, you don't want to max yourself out. Like you've probably heard the term being house poor. When you're house poor, that means your debt ratio is usually probably the close to the max, which sometimes it can work. Like if there's just one person on the loan, maybe they have other people living in the home, like a spouse, like that. So it makes more sense. But usually the lower your debt ratio is, the more easy it is to qualify, and it's a lot better for you and your financial situation. So what the debt ratio takes into consideration is it basically looks at your monthly income and it compares it with all of your monthly expenses, like credit cards, car loans, student loans, things like that. What it doesn't use is like your cell phone bill or your utility bill, things like that. Those are not included in a debt ratio for qualifying for a mortgage. So obviously, if we do, an application and your debt ratio is too high, there are ways that you can lower it. Now, sometimes it sounds easier said than done, but paying down credit cards, paying off car loans, anything like that will reduce your debt ratio, and you can do that during the pre-qualifying stage. You don't have to do that before doing the application, which is another big question or statement that I get is, I want to pay this off first. I want to do this to get in a better position. Well, again, I can help with all of that. Sometimes I've had people pay things off that they didn't need to do, because paying things off that requires money or cash. So you always want to make sure you have enough cash to actually buy the house. So that's why doing the pre-qualification, it's never too soon to do that, because I can help you allocate your cash to where it could need to go. A lot of people think they need a perfect credit score to buy a house. What's the real deal? Well, that is not true. Yes, it is ideal to have your credit score 780 and all the way up through 800. Yes, for the best interest rate pricing, all that, of course. But you do not need to have a perfect credit score. Usually, 620 is kind of a number we look at, but I have seen get approvals with lower credit. Down payment assistance program that we have actually has a lower credit minimum score. So you don't need to have the perfect credit that you might think. Again, this all kind of ties back to doing your application, getting pre-qualified, and making sure you know without assuming. All right, now let's talk about self-employed income versus W-2. What do people need to know? W-2 employee means like you are employed by a company or another business where you're usually getting a pay stub every 2 weeks, maybe every week. It's more of a scheduled type of income. Maybe you have a salary. That is usually easier sometimes to get qualified as a W-2 because you are employed. You have a guarantee. Where it gets a little trickier with self-employed, it isn't guaranteed. It could be 1 month you could do really well, 1 month you might not. So with self-employed, we just look at a longer picture. Like usually 2 years of tax returns. If you've owned a business for 5 years or longer, we can just use your most recent tax returns. So it has gotten a little better to get qualified self-employed, but that is the main two differences. Self-employed income varies. W-2 income is usually steady, straightforward, same amount every 2 weeks. So as I mentioned about how self-employed income can fluctuate or vary, that also works too with somebody that has maybe multiple jobs and is a W-2 employee where they're getting a guaranteed amount at each job. But if it varies from week to week, then that kind of ties together with the self-employed calculation. So for example, if somebody has a W-2 job and maybe 1 week they work 20 hours, the next week they work 36, maybe 1 week they work over 40. If that's the case, and if it's an hourly position where it fluctuates how many hours per week, then we do need a longer history to verify good average income versus somebody on a W-2 that's got a guaranteed salary that doesn't change. So varying income on a W-2 is correlated with self-employed, where we do need a longer history to verify. Okay, so let's clear this up. Just because you can qualify for a $500,000 home, does that mean you should buy one? No. If you cannot afford the payment, or you think at the end of the month when you make your mortgage payment, you are basically, again, back to the term house poor, you should not purchase that home. And I always tell people this all the time. Just because you can qualify for something doesn't mean you should actually buy it. And the reason is we use gross income in most of our income calculations. Well, gross income, you're not taking home every 2 weeks or however you're paid. So we always want to make sure, even if you're qualified for something, make sure that payment is doable for you, even though it looks good on paper. So here's the big question. We all hear it. Do people really need 20% down to buy a house? Let's break this down. The simple answer is no. 20% down is a very common used phrase on conventional loans because it gets rid of the mortgage insurance. But you do not need to put that down. Conventional loans do allow anywhere from 3% for first-time home buyers to 5% for people that have owned a home in the past. Also, FHA, VA, they also have way less down payment requirements. VA, you don't have to put anything down at all. You can do 100% financing with VA benefits. FHA, it's also similar to conventional, where it's 3.5% is the minimum down payment requirement. So again, this is all part of the pre-qualification process where we look at all the different loan types and make sure that you get into the one that best fits your needs. And it's also why it's important that you work with somebody that you know that is experienced, because you don't want to just have someone put you in the conventional loan just because that's what you said in the first sentence when you guys were speaking. You want to make sure you know all of your options and know every single thing about each loan type. So, how do you get pre-qualified fast? All right, let's say someone wants to get pre-qualified today. What is the fastest way to make it happen? This happens all the time, usually on the weekends, because usually people go out and start looking at homes before they get pre-qualified, which we know is a big no-no, but let's say that does happen. So you need to go fast. Let's say you need to make an offer really quickly. So I have a really quick online application that you can complete in literally a few minutes. I get notifications once it's once it's finished. It really doesn't take me a long time to go through, process everything, and get you pre-qualified and fairly quickly. As you're filling that application out, it also prompts you to upload documents how you're filling it out. For example, if you say you are a W-2 employee, it will ask you right away for most recent pay stubs. It'll ask you for W-2s. We will need to review all these documents before we can issue a pre-qualification letter. But as you're going through, you could literally have all of your banking information, income, and your credit all done as you're filling out that application. It really takes me about 15 to 20 minutes to go over. Yes, sometimes maybe we'll need to take a little longer, but that is a quick and easy way and allows us to get it done very fast for you so you can make that offer right away and not miss out on the home. Last thing, what are the biggest mistakes people make after getting pre-qualified? The biggest one is opening new debt. So we do not want any new debt open. Even if you're just getting pre-qualified, maybe you're not even looking to go out and look at homes for at least 30 days. Anything you do after we do that initial application, we will get notified. So if you go out, buy a new car, buy new furniture, any type of financing, we will get an alert, and then we have to document that. Maybe you don't actually open up new debt, but it's going to give us an alert, and we're going to want to make sure that that's documented. The thing that can hurt you with that is if you do open any new loans, debts, credit cards, is that could impact your debt ratio, as we discussed before. And if you're already kind of tight, qualifying for the price range you wanted, adding more debt to that is not going to help. Other mistakes are people move money around a lot. Say we verified all your assets, they're in one bank account, and then later on they start transferring it over to another bank account, maybe opening other bank accounts, moving money around, large deposits. Any large deposits are going to have to be documented. Pretty much want to stay on an even line after you get pre-qualified. And if you do need to do anything, just give me a call first and we can walk through it and make sure that you're not doing anything that could negatively affect your qualification. Also, we just discussed how doing anything pulling credit, opening new debt can affect your qualification. The other thing that is a big one too, is anything with your income. Don't change jobs if at all possible. Sometimes there is cases where if you do a job change, maybe we can use that new income, but if it's not a guaranteed salary, I would not change jobs while you're getting pre-qualified, especially when you're out looking at new homes or go under contract. That's when you really need to keep your income all the same, your credit the same. Don't open any new debt. Keep your money where it is. And basically, don't do anything unless I tell you to. So to kind of wrap this all up, we kind of talked about the importance of getting pre-qualified, all the steps needed, what to do, what not to do. There was a lot of information there. So what I encourage you all to do, give me a call. We can walk through it. We can address questions you may have. Remember, doing the pre-qualification, there is no cost, there's no obligation to you. It's just going to get you on the right step to getting approved for a home loan. If you have any questions, please give me a call. We went over a lot of information, and there's a lot of steps to it. So we want to make sure you're on the right path. And like I said, it is never too early to start. There's no cost, no obligation. Call me today. Let's get you pre-qualified and get you into your dream home.